Administration. In the latest week, U.S. crude oil exports jumped to their highest point since July, to 1.8 million barrels a day. Our guest says the increase suggests global demand is rebounding. We're joined by Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thank you very much indeed for joining us. One thing you're focusing on here is strengthen the distillates market, which includes diesel, of course.
Yeah, so we saw some pretty nice draws today on the distillate inventories with the data that came out at 10:30. And the reason why that's been kind of important kind of signal for the market is this has been an area of the market where demand has been very sluggish through all of 2024. And just to see a pickup there is a nice indication that maybe kind of the demand profile is starting to increase or stabilize a little bit. Obviously, there's a lot more to put into context with how crude is trading today outside of that. But along with the motor gasoline demand we saw in the U.S., we did see a rebound in crude following those numbers. The export number was also kind of a really nice indicator. Obviously, that's driven by differentials and ARBs across various markets. But Europe has been rather weak, and to see a little bit of a pickup there was another positive signal. So all in all, the data set that came out today for crude oil inventories, although the draws weren't as big as some might have hoped, under the surface showed stronger demand, and I think that's why we originally saw the commodity rally. Now, obviously, we've given back those gains after the Fed meeting as risk assets as a whole are really getting hurt. But I think if we just look at the data set that came out, I think the read-through was fairly positive.
A further crackdown on Russian oil is a bullish factor here. Apparently, European nations are stepping up insurance checks on Russian vessels. And now the Danes are saying that Russia might be sending out warships to accompany its oil tankers.
So we've certainly seen over the past 2 weeks a ratcheting up in sanctions rhetoric and additional sanctions on various tankers. Now, that's not just on Russia, that's also been on Iran. And it is starting to impact, I think, some of the insurance and kind of the flows and the concerns around whether we start to see a little bit more friction on the sanction side. Keep in mind, there hasn't been a barrel of Russian crude that hasn't made its way to the market, even though we've had this price cap. And Iran crude has been pretty much free flowing into China. I think there's been some tightening up, not just from on the Russian side, kind of the additional pressure on the sanctions. But if we look at China, who's the main buyer of Iranian crude, I actually think they're taking a step back and getting ready for maybe this change in administration and what those sanctions might look like, and not kind of buying every single barrel they can. They might be saying, okay, let's back away from this. Let's see how things play out in the new administration. And we don't want to make ourselves a target per se. So we have seen some of the Chinese demand for Iranian crude slow down, and that has lifted some of the Middle Eastern grades, the demand, and has provided a little bit of a physical bid or physical demand signal to crude, which has been supportive. Now, that's all again in the context of this macro environment we're in, right, where we're really concerned about tariffs and growth. So we're seeing these physical market indicators be somewhat bullish and strong, but the macro backdrop, which is the key driver right now, does remain actually pretty cautious, and bearish sentiment kind of pervasive there, which is why the commodity just kind of rallies and stalls, rallies and stalls. Every time I come on here, crude's battling $70.
You're right. And oil just meandering over the past 2 months. Do you see much of a prospect for a significant rally in early 2025? You did talk about the bearish factors there, Rebecca.
So that's a great point. And I think the more we've talked about the bearish factors and the more I look at analyst estimates, I do think a lot of the negative kind of catalysts or the overhangs are starting to get reflected in price. That doesn't mean there's not some downside, right? If we do get a really extreme tariff across, China, Canada, Mexico, we could see some downside in crude. But I do think this kind of baseline bearishness has been priced in. And that if we do get any kind of positive data point, but this is crucial, on the demand side, crude could rally. And I think that we are setting up for that because sentiment is just really, really quite sour. And when I look at it, we're pricing in kind of a pretty worst case scenario in a lot of aspects in crude, but the rest of the markets seem to be pricing in kind of a more moderate outcome. So I think there is room for upside here. I do think we're at the very sensitive end of year here, and it's hard to deploy a lot of capital. And I think a lot of traders think along these lines. So it's going to be difficult, I think, over the next couple of weeks to see a sustained rally. But as we head into 2025, I think upside surprises are not priced, and you could see crude trade up $5-6 on a better demand profile and not quite as bad as feared situation.
That's interesting. It's an illiquid time of year, but you think a lot of the bad news may be priced in. Thank you, Rebecca. Really appreciate it. And if we don't talk to you before the end of the year, have a wonderful holiday.
You as well. Thank you so much.
Always great having you on the show. Rebecca